Well, looking at the latest bit of economic data that's filtered through, those PPI numbers, 7.4% were where we had forecasts ranging of between 6 and 7%. So it's broken outside of that band. Has it come as any surprise to you?
It's not a surprise for us because we're seeing a resurgence in the manufacturing sector, although it's not as broad as you would like to see it. Particularly if you look at sectors like construction, where we know it's very, very hard for construction companies. But it's also an issue around the fact that the producer prices are now on the rise, and therefore being on the rise, we may see the effect coming through on the consumer side as in some sectors prices get pushed into the consumer, and therefore it makes sense why last Thursday the Reserve Bank made such a statement that is quite worried about global developments, but also domestically, particularly around wages, which is at the factory, which is likely to push producer prices going forward.
Well, like you say, it's the usual suspects that we're looking at: electricity, fuel, coal costs as well, and we're starting to see food prices, which have been subdued in the past, also playing an increasingly important part here. And as you've highlighted as well, we had the South African Reserve Bank governor last week move out their inflation forecast. They've said they see slight near-term deterioration, and that being expected in the fourth quarter of this year. What's your outlook on that inflation front?
Well, as I said, that we need a preemptive strike. A preemptive strike is quite important in the sense that it sends messages that as a country we have to think and look inwardly about what type of a South Africa we want. We saw the diagnostic report coming from the commission, the National Planning Commission, which is quite clear that for us to move forward and address those challenges, those 9 challenges which came out of the report, we need to think differently. Therefore, those of us who are in the formal sector are making money. We need to think about how much of it we can give back into companies, so these companies can grow, they can employ people. However, the wage discussion taking this country leave a lot to be desired because they're all short-term. They all forget about those outside the labor pool. Therefore, that's the thing that I think the Reserve Bank is saying, and that's what the National Planning Commission is saying. And therefore, somewhere, somehow, we're missing each other. As a result, we're not going to be able to really make a dent. That's why I'm saying maybe a warning is high interest rate. Maybe people with high interest rate, they think differently. They start asking themselves, what role as an individual and as a collective, if I belong to a union or I belong to an institution like the one I work for, to make sure that we lower the cost of doing business, so that companies are able to expand, are able to create those jobs that we require by 2020, at least about 5 million jobs.
That having been said, the argument that's come very vociferously to the table from the union's end is that those at the bottom end of the wage earnings curve is experiencing a much higher inflation rate and a cost of living than those at the top end of the earnings bracket. So how do you reconcile that, and what would be a reasonable demand from their end, where, yes, officially we're looking at inflation currently sitting at 5%, but they're experiencing it significantly higher, and bulk of that via transportation costs?
That argument holds water. That argument holds water in relation to those that are in the formal economy. We need a different solution. The solution which the National Planning Commission put on the table, that let's look at what we've got and let's try and meet each other. So there's a serious discussion that needs to take place between the employer and the trade union to say, we as employers, as executive, we're going to take less than inflation wage increases. Workers do the same. So we close that one. Because as workers, as the people in the formal sector, we know that millions of South Africans don't have a job. So for the employer to take less than inflation wage increases, as well as the employee, then less than the companies expand capacity so that we bring in those others that are outside. So it's a sacrifice that is required. However, we're not going to see it because no one is genuinely committed to the poor. everyone in South Africa talks and represents the poor, is the voice of the poor. However, the actions and the demands that we put in the economy far exceed what every South African should be doing, addressing the poor and taking serious sacrifices to grow the economy, to grow the manufacturing base, so that we can bring in those that will never see the jobs if we continue the way we're continuing.
So strike season, whether you agree or disagree with the merits, in full swing and really adding to the woes of our economic growth prospects. Impacts, as you see it, to Africa's largest economy. What is it actually costing the South African economy?
It's costing us dearly. Not only is it an inconvenience for the service sector, because quite a lot of us are inconvenienced when we go and buy petrol. Not only do we buy petrol, we buy other things. You go and buy gum, you go and buy the Walmart issue, where we need competition in that sector to make sure that we can bring prices lower, so that the inflation rate is lower, so that the poor have got access to cheaper and affordable food. I'm never going to say it, because the politicians and the trade unions are all ganging against a global player, which we think that our judgment, whether they've delivered or not, will be on how low the prices come down for the consumer, which is going to be coming in the next year, 2 or 3, because a priori, we can have emotional arguments. You can argue against the Walmart deal, but the reality is that we want competition. There's no competition in that sector. There's alleged collusion in that sector, so we cannot really block that deal going through.
That aside, we also want FDI into the country.
Exactly.
And looking
Agreed.
at the rand, I mean, we've seen it, holding relative strength and looking very, strong at this stage. But the concern lies around the fact that it's not longer-term money flows that's supporting that strength. It's hot money, where we're seeing foreign investors piling into the equity space, into the bond market, that's fueling that rand strength right now. What's your outlook on the FDI front and South Africa's ability to rein that in?
Very negative. We've talked about Walmart. We're talking about the nationalization debate. We talk about quite a lot of uncertainty.
We're talking about uncertainty at the DMR offices where the Hawks have raided.
So all these negative things are stacked against us. We're missing an opportunity. This country, given our capability, given of what we've built in the past 120 years, when we started to industrialize, we can do so much in the rest of the continent. In this country, the rest of the continent, and take on the Indians as well as the Chinese and the Brazilians. But we're sleeping, we're busy arguing around peripheral issues, when we know that our success as a country will be measured against the quality of life for South African, which at the moment is deteriorating, except for the very few in the formal sector.